trillions in digital dollars, shifting. Central banks feel the pressure now. The International Monetary Fund is warning that stablecoin risks are now a serious global issue. In this BlockBrief report, we outline how dollar-pegged stablecoins could speed up dollarization and weaken the tools that central banks rely on to manage inflation and capital flows. Dollarization happens when people abandon a fragile local currency for one they trust more. Today, it can mean stablecoins held in a phone wallet, outside domestic banks, and sometimes outside the direct reach of regulators. The fund is especially worried about countries with high inflation, weak institutions, or long histories of banking turmoil. In those economies, stablecoins offer fast access to digital dollars. Households and firms can quietly move savings away from the local system with a few taps, without opening a foreign account or queuing at a branch. As more value migrates into dollar-pegged tokens, domestic policy tools can lose power. Interest rate moves matter less if savings and payments sit in stablecoins instead of local deposits. Capital controls and other safeguards are easier to bypass when cross-border transfers run through blockchain networks rather than supervised banks. The report underlines the scale of the market. Tokens such as Tether, known as USDT, and US dollar coin, known as USDC, have seen their combined supply multiply since 2023. Their total value now stands in the hundreds of billions of dollars, and yearly trading volumes reach into the tens of trillions. A shock in a market of that size is unlikely to stay inside crypto. The fund also sees real benefits. In many emerging markets, digital wallets and fintech apps reach people faster than traditional branches. Stablecoins can lower remittance costs, speed up everyday payments, and broaden access to basic financial services. But the same features that make stablecoins attractive also create new vulnerabilities. One major risk is a sudden loss of confidence in a big token. If users doubt the strength or liquidity of reserves, they may rush to redeem or dump their holdings. Issuers would then need to sell large portfolios of assets, including government bonds, in a short period. That kind of forced selling could strain bond markets, raise borrowing costs for governments, and transmit stress across borders. The more central a stablecoin becomes in daily payments and trading, the more disruptive such a run could be. The pseudonymous and borderless nature of many stablecoin transactions adds another layer of concern. Value can cross borders without passing through regulated banks, complicating efforts to enforce capital controls or fight illicit finance. When large holdings sit in self-hosted wallets, even basic information about who owns what becomes less reliable. Regulation is advancing, but unevenly. The fund compares rules in the United States, the European Union, the United Kingdom, Japan, and other jurisdictions. It finds different answers on who may issue stablecoins, what counts as high-quality reserves, and how foreign issuers should be supervised. That patchwork invites regulatory arbitrage and weakens oversight. The fund does not call for banning stablecoins. Instead, it treats them as a lasting feature of global finance. Their eventual role will depend on whether regulators can coordinate standards on reserves, transparency, governance, and the technical links between payment systems. Good rules could allow innovation while reducing the risk of a destabilizing run. For investors and traders, the takeaway is straightforward. Stablecoins remain vital to crypto markets, but they are not risk-free cash. Scrutinize transparency reports, reserve disclosures, and responses to regulatory questions. Pay close attention to adoption trends in high-inflation economies, where dollarization pressures are strongest. This has been BlockBrief. Stay informed, stay ahead.